Okay, I'm going to teach you a little bit about the Federal Reserve right now, why we have it, what it does in some very basic terms. You've seen that little cartoon video that the Federal Reserve made for high school students, sort of as a background of what happens. Over the next several days, you're going to be learning, you're going to learn about interest rates a little bit. You're going to learn about how banks work, how the Federal Reserve works, and how all this stuff comes together to make something we call monetary policy. Okay? Let's say there are three banks, Bank 1, Bank 2, Bank 3. Okay? You may or may not know this, but banks loan each other money all the time. Okay? Banks are always loaning each other money. They are each other's customers as well. And before the Federal Reserve, this still happened, but sometimes banks would become weak, and when they would become weak, they might fail. And when they would fail, it would make people less confident in the banking industry. So for example, let's say this was a strong bank. Let's say this was a weak bank. And let's say this was sort of in the middle. It's okay. Well, what a weak bank means is it has loaned out a lot of its money, too much of it. And let's say some people walk in to get their money and this bank doesn't have it all. Well, that sends what we call a panic through our system when banks don't have our money. All right? It doesn't happen now because we fixed this system, but it did a long time ago. And so people would start coming and asking this bank for money. Well, the bank had loaned so much of it out, it would have to go to the people who it gave money to for loans and say, hey, I know we gave you this money for a house and for a car and for stuff. We need the money now. We got to have the money now. In 30 days, you're going to pay all of it. I don't know if you know this, but when your parents or eventually when you sign off on a loan, in those small little print, it does say that they have the right to call that loan in or make you pay within 30 days. They don't traditionally do that because it doesn't make them money. It makes them money for you to pay over time. But, because the interest adds up over time, that's how they make their money. But if they start calling loans in, that means people start getting their houses foreclosed on, their cars taken. And this bank, they'll go and get all this money, and all the money's gone. So this bank fails. Well, that sends a signal that banks might not be trustworthy. So now people that go from the middle bank, the bank that was pretty solid, and it's loaned money out, now all of a sudden all of those customers going into this bank and saying, we want our money now. Well, again, banks aren't built to give everyone all of their money at one time because they've loaned most of that money out. So now this bank has to start paying people back and calling in loans and foreclosures and stuff. And all of a sudden this bank goes out of business. And now this bank is in trouble even though it's strong. So in 1912, in 1913, Congress passed the Federal Reserve Act. It happened as a result of what's called the Panic of 1907. And so the Federal Reserve was created, and it enforces what's called monetary policy. But it's a very basic thing. It does some pretty good stuff. And one of them is the Federal Reserve, and there are 12 Federal Reserves around the country. Okay, if you look at a $1 bill, you get your $1 bill out, you can look at George Washington's picture. On the left-hand side of George Washington's picture, there'll be a city and a state with little circles. There'll be like a letter in the middle and then two circles around it. And it'll say like New York or Philly or Boston or Richmond or D.C. or Atlanta or St. Louis or Cleveland or Minneapolis or Denver or Dallas or San Francisco. I'm probably missing one or two. Those are all Fed banks. And what they do is they provide money to all of these banks if they need it. So the banks can keep loaning money out, and the banks can be secure and what we call liquid. They'll have plenty of liquid assets, which means they have money. And so banks can now borrow from each other. They still do all the time. But banks can also borrow from the Fed. So let's say that here's America. I just drew America because I'm an awesome artist. This is America, if you can't tell. I'm sorry, so sorry, Daisy. This is America, and here's Kentucky. So let's say somebody in Kentucky wants to borrow $10 million from a bank. Well, they go to their bank and they ask for $10 million, and maybe the bank doesn't have it, but the person looks like they have a great plan for a business, and they need this $10 million to start their business, and the bank thinks, well, we can really make good money off of this. So the bank might go to the Fed, right? The bank might talk to the Fed and say, we need $10 million to give this customer, all right? So we have the Fed, we have the bank, and then we have a customer, okay? So the Fed will give the money the Fed will give the bank some money, $10 million, and then the bank will give the customer $10 million. Well, the Fed is going to charge the bank an interest rate. We call this the discount rate. That is the rate at which the Fed charges banks. And the bank will charge the customer an interest rate, right? So they'll charge an interest rate here. Let's just say, to make the math easy, the Fed charges 2%, and let's say the bank charges the customer 7%. Well, what that actually means is the Fed is making 2% off the bank, and the bank is making 5% off the customer because they had to pay 2% back to the Fed. So the Fed's making money. The Fed's making sure there's money all over the place so the companies can keep getting money. People can keep getting loans. The bank is making money because they're loaning it out. And people are getting to consume and buy and build houses and start businesses and expand businesses. So technically, everyone's access to cash is held by the Federal Reserve, which didn't happen before the Federal Reserve. And all of this is based on interest rates we learned about the other day, where interest rates send a signal. The lower the interest rate, the more we want to borrow money. The higher the interest rate, the less we want to borrow money. Right now, during the pandemic, the Fed has made the discount rate basically almost zero because they need people borrowing money to keep these businesses going, particularly when we come back from sort of this staying inside time. So you're going to see a lot of information of the Fed trying to get people to take out loans as much as possible by lowering the interest rates. This is how the Fed works. This is one of its most basic functions, making sure there's plenty of money everywhere, loaning to banks, and making sure that we all have access to cash if we need it through loans. There's also what we call open market operations we're going to talk about, but this is an important part of the Federal Reserve and one of its most basic functions to keep things going. It also acts as what's called a clearinghouse. So when you write checks, they go through Federal Reserve banks to clear the checks from one bank to the next. It actually serves that purpose too. So Federal Reserve serves a really big purpose. Now I talked a lot about that on that video you saw first, and here is sort of my explanation of very basics of what the Fed does. Okay.